Hi, Assalamualaikum. My name is Nihidaya binti Azmi, and now I want to present about capital structure. Firstly, what is capital structure? Capital structure is the specific mix of debts and equity it's employed to fund its overall operation and growth. Next is the equity capital is derived from the company ownership shares and claims on futures, cash flow and earning. And next, the third one is the capital. The company capital structure can include long-term debts, short-term debts, common stock, and preferred stock. And lastly, is corporation can raise money in the financial market through debts. Okay, now we move to the how to determine optimal capital structure. Okay, firstly, we should be capital structure can be by determining the debt to equity ratio that reduced a company weighted average cost of capitals. The second one is should be to determine the ideal capital structure that will result the lowest WACC and the highest business value. And then lastly is we need to analyze the amount of leverage other businesses in same industry to use to evaluate if the company is using an unusual level of debts in capital structure. Okay, next we move to the effect capital structure and the capital structure decision. Number one is capital structure decisions are related to both firm level and micro level factor according to several empirical research. Number two is capital structure decisions are influenced by stock market conditions, namely stock price fluctuations. Number three is a component capital structure options are trade-off between debt tax benefits and the cost of financial hardship. Number four is industry gains from the use of resources that allows it is to distribute its cost across the activities that demand the most expansions. And the last one is it must guarantee that a sufficient supply funds manager is in place to that small and medium-sized businesses can access and track innovative initiative. Okay, now we proceed to the financial distress. What is financial distress? Financial distress is occur when a business of individual is unable to generate adequate revenue or income to satisfy or pay its financial commitment. It is because firstly is experience financial distress as a result of budgeting, overspending, having too much debts, and being sued or lost their jobs. Next, it is because the company of or individual liabilities have become too high and cannot be repaid. And next one is sales are declining and or growing slowly suggests that demand for a company's product or service not meeting expectations based on the current business strategy. And lastly is because cash flow can be significantly strained if that take too long to pay their debts to the company. And now we move to the integration of tax effects and financial cost distress. Firstly is a probability of distress is so low so that the present value of the distress cost is tiny. Number two is a present value of this expenditure. However, it rise at an increasing rates as more debts is accumulated. Number three is a company capital structure options a trade-off between debt tax benefit and the cost of financial hardship. And lastly, the optimal debt level become the company desired debt level. Okay, now we go to the agency cost of equity. Firstly, it is because the conflict of interest that emerge between management and shareholders is referred as an agency cost of equity. Next is because of steps to encourage an agent to operate in its best interest of the principal may also help to elevate the challenges associated by agency changes. And lastly is because of programs to increase employee satisfaction, which would reduce costs related to employee turnover, and are some ways to ensure that both agency costs are equity and debt reduces. Okay, now we go to the pecking order theory. Firstly, it because a manager preferred the following from and funding for investment opportunities. And first, because it's retained earning and debts, or finally equity finance. Next, because a creditor and investor often to make more informations and firm performance because of prospect, risk, and future outlook than corporate manager. Okay, now we move to the retained earning. Finance becomes straight from the corporate and reduce information's asymmetry according to pecking order theory. And lastly, because internal finance is the cheapest and most important method of funding as opposed to external financing such as debt or equity financing, which required to company to pay fees. Okay, lastly, we go to the signaling hypothesis. Okay, signaling hypothesis is on about underpricing theories based on the signaling belief that issuing firms managers know more about their firm's quality and outside investor. Next, because high quality companies will underprice in order to get a better price when they return to the public market. And lastly is because a poor quality firms cannot benefit from underpricing, that is if the two state or quality of the firm is revealed from before the firm conduct say a follow-on season stock offering. That's all my presentations about capital structure. Thank you for watching.